Hey savvy investors, let me start by saying this. I was so wrong about REITs. And as someone who's been a long-term REIT investor, adopting a patient approach and focusing on quality REITs that can weather tough times, admitting that feels a little painful, especially publicly on YouTube. If you've been following my channel, you'll know why I had such high hopes for their recovery. So today, let me share what happened, the headwinds REITs are facing right now, and whether there's still light at the end of the tunnel for us long-suffering REIT investors. And as always, I'll share my reflections on what we, as dividend investors, can do to adapt and move forward. Before we dive in, let me remind you that this video is for informational purposes only. Always consult a licensed financial advisor for advice tailored to your financial needs. And yes, I hold REITs in my portfolio. But remember, what works for me may not work for you. Alright, let's get started. Twice wrong about REITs. Now, let's talk about where I went wrong, twice. When REIT prices began to climb in October 2023, I was convinced that the long-awaited recovery had finally arrived. After all, REITs had been undervalued for years, trading at historically low price to net asset value ratios. The rallies seemed to confirm my belief that patient, long-term investors like us would finally be rewarded. So, I jumped in, adding to my positions in several REITs. For example, I bought Mapletree Logistics Trust over several months, from October 2023 to January 2024, chasing the price up from $1.47 to $1.74 per unit. But instead of continuing its climb, the price tumbled down and likely to end the year at about $1.25, leaving me with losses I hadn't anticipated. Fast forward to August 2024, and it felt like déjà vu. The REIT market showed signs of life again, and I couldn't help but believe this time was different. For example, I added positions in Mapletree Pan-Asia Commercial Trust, buying at prices from $1.25 to as high as $1.50, confident that the rally would hold. But, just like before, the market lost steam, and the prices fell back again. Both times, I thought I was making rational, data-driven decisions. Both times, I was wrong. The primary culprit for the abrupt end to these rallies? Inflationary pressures that rolled back market expectations of interest rate cuts. What seemed like a clear path to recovery was derailed by economic realities that left REITs struggling to regain their footing. And to add salt to the wound, I had deployed much of my $100,000 cash reserves, or dry powder, into these purchases. I was so optimistic that I used up significant portions of my cash, leaving me with less flexibility for opportunities ahead. I've always believed in the long-term value of quality REITs that can weather economic cycles. But watching the rallies fizzle out not once but twice felt like a punch in the gut, especially after pouring so much dry powder into what I thought were promising rebounds. The headwinds ahead for REITs. Let's take a closer look at the challenges REITs are currently facing. These headwinds are significant and explain why the sector continues to struggle despite its attractive valuations. 1. Interest rate trends. A slower than expected decline. The most obvious challenge is the direction of interest rates. While we were initially expecting up to 4 rate cuts in 2025, after the hawkish remarks by U.S. Fed Chair Jerome Powell in mid-December 2024, this has now been scaled back to just 2. This slower pace of easing means that REITs will continue to face elevated borrowing costs for a longer period. As existing loans mature and are refinanced, even quality REITs with currently low average interest rates will see an increase in their interest expenses. This could include Fraser's Logistics and Commercial Trust. This directly impacts distributions to unit holders, making the yields less attractive in the short term. For REITs looking to dispose of their properties to shore up their balance sheet, the elevated interest rates mean that potential buyers will be lacking and offer prices less ideal since most of these buyers would need financing themselves. 2. Underlying business pressures. The fundamental businesses of many REITs are also under threat. For office REITs, the shift toward hybrid work models continues to weigh on demand for office space. Although Singapore office have performed better than other regions due to the more rapid return to office, cracks are starting to show. Going forward, AI-driven trends could further impact workspace requirements. What about retail REITs? Unfortunately, even the bulwark of Singapore REITs is facing its own challenges. Tourist recovery is slowing down, and a stronger Singapore dollar have made Singapore less attractive for shopping. At the same time, more Singaporeans are going overseas, riding on the stronger Singapore dollar. On top of that, with fuss-free cross-border shopping in Johor Bahru arriving within a year with the completion of the MRT link, There are real concerns by analysts and investors on the impact on suburban retail traffic. For hotel REITs, the skyrocketing room rates and occupancy rates post-pandemic might be coming to an end. The momentum of tourist recovery appears to be tapering, with less sources of new tourist arrivals after the return of Chinese tourists with the visa-free arrangements. Hotels are also feeling the pinch of a strong SGD, making Singapore a more expensive destination. Finally, business park REITs. Similar to offices, business parks are seeing softer demand due to companies in the tech and finance sectors reevaluating their real estate needs. These pressures mean REITs have to work harder to maintain or grow their rental income, adding another layer of difficulty. 3. Attractive alternatives luring investors. Finally, competition from other investment options has been fierce. Closer to home, the dividend stocks in Singapore has done very well, as reflected by the Straits Times Index or STI ending the year close to 17-year highs. This has been led by banks, which has been delivering strong returns. Dividend stocks have definitely outshone REITs in both income and total returns this year. Over in the US, the tech and AI-led rally pushed the S&P 500 to deliver close to 30% returns in 2024, after a similarly strong performance in 2023. With such stellar performance, it's no surprise that investment money, both institutional and retail, is flowing into these sectors rather than REITs. When investors see these alternatives performing better, the relative attractiveness of REITs diminishes, especially given the challenges they face. Is there light at the end of the tunnel? But is it all doom and gloom for REIT investors? There might be reasons to remain cautiously optimistic, especially if our time horizon continues to be long-term. First, while interest rate cuts may be slower than what we had hoped, the direction is clear. Rates are coming down. This offers a glimmer of hope for REIT investors, as lower rates would ease borrowing costs and potentially boost distributions over time. Importantly, the outlook today is not as bleak as it was back in August 2023, before the two failed rallies even began. Yet, despite this slightly better environment, the prices of many REITs are still trading at or even below their August 2023 levels. This creates a situation where the long-term potential for recovery could already be present, but investor sentiment has remained at rock bottom. But of course, this remains subject to market conditions. Second, REIT managers are not sitting idle. Many are actively strengthening their portfolios through acquisitions of higher-yielding assets or assets with greater potential, divestments of non-core or lower-yielding properties, and asset enhancements to improve rental income. There are so many examples, but just to list a few for illustration. CapitaLand Integrated Commercial Trust's acquisition of Ion Orchard, a prime retail asset to take advantage of recovering tourist arrivals. Keppel DC REIT's major acquisition of data centers in Singapore to tilt its portfolio further towards Singapore. And CDL Hospitality Trust's acquisition of the first student accommodation asset in Liverpool, UK, aimed at improving the stability of its distributions. These proactive measures show that REITs are adapting to the current environment. Finally, this experience reinforces the importance of having a diversified portfolio, even for investors, like me, who continue to love REITs, despite having been burnt by them. Being too heavily focused on one sector, like REITs, can be risky, as this year has shown. For me, diversification means having a mix of income and growth assets in my portfolio. If you like dividends, sure, but make sure to consider having a good mix of REITs and dividend stocks from different sectors providing you with those regular cash flows. Having quality non-REIT dividend stocks making up the STI would have helped boost dividend growth this year. And consider adding some growth stocks into the mix. Growth doesn't always mean taking on excessive risk. If you're concerned about the higher valuations in the US, investing in a globally diversified ETF, for instance, can add a touch of stability and growth to complement your income portfolio. Yes, the US stock market went up by 30% this year, but the global index also performed well at more than 16%. It's about creating a mix that works together to weather the storms and seize opportunities. The Dividend Uncle's take. So, what's my take on all of this? Well, I may have been wrong about REIT recoveries in the past, but the lessons I've learned have been invaluable. Investing isn't about always being right. It's about adapting, learning, and staying disciplined for the long term. Yes, REITs are facing challenges, but they're also evolving. For investors willing to be patient and selective, the current undervaluation could present opportunities. Personally, I'm not giving up on REITs, but I'm committed to maintaining a diversified portfolio that balances income and growth, so I'm not overly reliant on any single asset class. But as always, my portfolio decisions reflect my individual goals and risk tolerance, and they may not align with your financial needs. What about you? Are you holding on to your REITs, or have you shifted your strategy? Let me know in the comments below. And if you found this video helpful, give it a like and subscribe to the channel for more insights. Here's to learning from the past and investing smarter in the future. Happy investing!